Ali from Livewire Markets. There's been a change in tune between your statements in March and May. Back then, inflation was falling in line with forecasts and there are encouraging signs that inflation was moderating. Now inflation is declining slower than expected. You mentioned it's been a bumpy ride. Given these changes or omissions, would you agree the board is significantly more concerned about inflation than it was 6 weeks ago? And if that's the case, why not hike rates today?
I think let's just take a step back a little bit and think back to November last year when we raised interest rates. And at the time we thought the risks had shifted a little bit to the upside and we were taking out a little bit of insurance. It's true that the data towards the end of last year and the early this year led everyone to sort of think, oh, it's okay now. I think we've always felt that it was a bit too soon to declare victory, and I think the numbers in recent weeks have demonstrated that for us. We think policy is restrictive. We don't think we necessarily have to tighten again, but we can't rule it out. If we have to, we will. If we really think that inflation is going to be persistent and significantly above our forecast, we will tighten again. But the board made the judgment at the meeting that the right stance at the moment is to stay where we are, continue to observe what's going on in the economy, be data-driven, and, as I said, we might have to raise, we might not.
Governor Peter Ryan from the ABC.
Peter.
Was there any discussion or debate at the two-day meeting about raising interest rates?
Yes, that was one of the things that the board discussed. So the board did discuss the option of raising interest rates. It discussed the option of keeping interest rates where they were. As I said, on balance, the board felt that at the moment, staying where they are was appropriate. We think that policy is currently restrictive. That doesn't rule out that we mightn't have to raise rates, but it doesn't mean we will have to raise rates. So there was a discussion about it, but the board decided on balance to stay where it was.
Governor James Glynn from the Wall Street Journal. The tightening cycle is now 2 years old as of today. Happy birthday. And it's 425 basis points old as well. And still the inflation rate is kicking around the 4% mark, and the unemployment rate, I think miraculously, I think we'll all agree, is sub 4%. There's a group in the markets that argue that that's evidence that the RBA simply hasn't gone hard enough. We should have mimicked the overseas example. You know, we've got the RBNZ going well above 5%, etc. And Australia should mimic that. How do you respond to those people who argue that we just haven't gone hard enough, that the Reserve Bank's been too timid, and you know, we may actually have to push the cash rate towards 5%?
So I would respond by saying that at the moment our judgment, as I said, is that we are on the tight, we have got restrictive financial conditions, and we see that in the household sector. You would know that there was some recent work done by the IMF, and it looked at how interest rates impact various countries, and it's very clear that it impacts Australia very quickly because of our relatively high share of variable rate mortgages. We're very conscious that we have a dual mandate. Yes, we've got to get inflation down, and if we don't get inflation down, it ultimately isn't good for employment. But we are trying very hard to get it down while maintaining employment growth, and that's the balance we're choosing. Have we got it right? Have we got it wrong? We think at the moment we're probably okay. Our domestic conditions aren't the same as domestic conditions in other countries. We do have our own domestic conditions to consider, and I think it's as I said, at the moment we think we've got it right, but things are uncertain, and if we have to move, we will.